In June 2025, an economic earthquake shook the foundation of global currency markets. The epicenter? Accra, Ghana. The Ghanaian Cedi, a currency recently associated with spiraling inflation, has just done the unthinkable. It has sprinted past the almighty US dollar, surging by a staggering 40% in just 6 short months to become, without exaggeration, the best performing currency on the entire planet. The numbers tell a story that borders on fiction. In January, you needed a handful of notes, 14.7 Cedis, to get a single US dollar. Today, you only need 10.4. The psychological impact is electrifying. In the bustling markets of Makola and Kajisha, importers of everything from Korean electronics to Brazilian corned beef are aggressively slashing prices, their cost of business having plummeted. Spontaneous street parties, fueled by a potent mix of national pride and cheaper beer, are erupting across Accra. Ghanaian news outlets and social media are ablaze with headlines that scream "Ghana beats America" and "The Cedi roars." What's the engine behind this seemingly miraculous turnaround? It's not one single factor, but a powerful trifecta of aggressive economic maneuvers. The primary driver is a hefty $2.3 billion gold for cash swap, a bold strategy where the nation's precious mineral wealth is directly monetized into hard currency. This has been paired with sky-high domestic interest rates cranked up to a jaw-dropping 29%, which act like a powerful magnet for foreign capital seeking spectacular returns. To complete the picture, the central bank has been relentlessly flooding the country's forex bureaus with a steady stream of greenbacks, ensuring the Cedi's strength is felt on every street corner. To the casual observer and the jubilant citizen, the Cedi looks utterly invincible, a symbol of a nation on the rise. Then, from its headquarters in Washington, D.C., the International Monetary Fund drops a 3-word bucket of ice water on the celebration. This won't last. Today, we're unpacking the full story of how a country that was recently gasping for air under 54% inflation is suddenly breaking world records. We'll examine exactly why the fund insists these celebratory fireworks are actually hiding a dangerously short fuse, and explore the potentially devastating consequences if Ghana's policymakers hit the snooze button on this urgent alarm call. The IMF's verdict on the Cedi's spectacular rally is not just cautious, it is brutally blunt. In closed-door meetings and leaked memos, fund officials have reportedly labeled the situation as artificial, engineered, and dangerous. This isn't the tempered language of diplomacy, it's the financial equivalent of a flashing red light and a blaring siren. The IMF's core argument is that Ghana is engaged in a high-stakes gamble, defending a fantasy exchange rate that is completely detached from the country's underlying economic fundamentals. This defense, they warn, will rapidly burn through the nation's precious foreign reserves, the war chest of dollars and other hard currencies that a country needs to pay for essential imports like fuel and medicine, and to service its international debts. Every week the Bank of Ghana props up the Cedi, that war chest gets smaller, leaving the country increasingly vulnerable to external shocks. Furthermore, the fund highlights a severe, unintended consequence of this policy. The resulting flood of cheaper imports could systematically torch Ghana's own local farms and factories. When imported goods become artificially cheap, domestic producers simply can't compete. The IMF's proposed solution is as simple as it is stark. The government and the central bank must step back. They must stop the heavy-handed interventions, dismantle the machinery propping up the currency, and allow the free market to decide the Cedi's true sustainable value. But Accra is pushing back, and pushing back hard. The political reality on the ground is worlds away from the theoretical models in Washington. As one senior finance ministry voice was whispered to have said, the IMF sees spreadsheets. We see voters buying tomatoes. With a crucial and likely contentious presidential election looming in December 2026, a strong Cedi is more than an economic indicator. It is an incredibly powerful political tool. It directly translates to lower prices for everyday goods, from a bag of rice to a gallon of petrol, easing the cost of living pressures on millions of Ghanaians and generating immense political goodwill for the incumbent party. While the opposition party issues dire warnings that you can't fight Adam Smith forever, The average street trader is simply happy that a 50 kilograms bag of imported rice has dropped from 760 cedis to a much more manageable 580. For now, the central bank appears to be ignoring the IMF's increasingly loud sighs, defiantly extending its weekly dollar auctions and keeping the party going. If you were to only glance at Ghana's top-line macroeconomic numbers, you might think the country's leaders look almost smug, and for good reason. On the surface, their report card is glowing. Gross domestic product, GDP, grew by a robust 5.7% last year, a figure many developed nations would envy. The Ghana Revenue Authority has been successful, with tax revenue beating its ambitious target, suggesting improved fiscal management. Perhaps most impressively, the national budget deficit is reported to be at its lowest level since 2011, a sign of newfound discipline. But these headline figures, as impressive as they are, obscure a much more troubled reality. Buried deep in the fine print of the economic data are a series of ticking landmines. The most immediate concern is inflation. While it has fallen dramatically from its crippling peak, it remains a stubborn 14.3%. This is far above the central bank's target and is a constant, grinding pressure on household budgets. More critically, the artificially strong Cedi is a double-edged sword that is beginning to cut into the very source of Ghana's wealth. The country's key exports, the cocoa, gold, and manganese that keep the lights on, are becoming more expensive and thus less competitive on world markets. This isn't just an abstract problem on a spreadsheet. It has a real, tangible, and human face. At the sprawling Cantonmento market in Accra, a trader who sells imported second-hand jeans notes a troubling paradox. While the dollar is cheap, making his stock easier to buy, his customers have less money in their pockets and still haggle relentlessly over every cedi. A few hundred miles away, a tomato farmer in the Brong-Ahafo region stares at crates of his fresh produce that he can't sell because processed tomato paste from Kenya, made cheaper by the exchange rate, has flooded the market. In the industrial hub of Tema, textile workers watch with anxiety as massive containers of Chinese fabric land at the port at a price that fatally undercuts the products from their local mills. This is a classic textbook case of Dutch disease, the economic phenomenon where a boom in one sector, typically natural resources, leads to a currency appreciation that systematically hollows out every other productive sector of the economy, from agriculture to manufacturing. For those who doubt the IMF's warnings, history offers a library of stark and cautionary tales about such rallies. The pattern is eerily and tragically familiar. Look at Argentina in 2006, Nigeria in 2013, and Zambia in 2010. Each of these nations saw commodity-fueled currency booms that were celebrated with nationalistic fervor, only to end in devastating crashes that wiped out savings and set their economies back years. The ghost of Nigeria's 2013 experience, in particular, haunts the corridors of Ghana's finance ministry. There, a boom in oil prices created a temporary glut of dollars, leading to an overvalued naira. The central bank intervened heavily to defend the currency's strength, all while a pivotal election loomed on the horizon. The subsequent collapse was brutal. The IMF's own internal research reinforces this grim outlook, showing that out of 42 similar episodes of sharp currency appreciation in emerging markets, a staggering 31 of them ended in a hard landing, a painful combination of a currency crash, a banking crisis, or a severe economic recession. This is precisely why the world is watching Ghana so intently. A messy unwind of the Cedi's rally wouldn't just be a domestic problem. It could send destabilizing tremors across other West African economies that are deeply intertwined with Ghana through trade and finance. It would inflict heavy losses on the Pan-African bond funds that have bet on the continent's growth story. Consequently, the situation in Accra is being monitored closely in the world's major capitals. Washington and Brussels, home to the IMF and World Bank, are watching, concerned about regional stability and the integrity of their financial support programs. Beijing, now one of Ghana's largest creditors and a major investor in its infrastructure, is also paying close attention, worried about the security of its loans and projects. In this sense, Ghana has become a crucial, real-time lab test for a fundamental economic question: Can a strategy of heavy forex intervention successfully coexist with long-term fiscal discipline? Or are they fundamentally incompatible? The domestic politics are just as fraught and volatile. A managed, or worse, a sudden and sharp depreciation of the Cedi would mean bigger nominal budget deficits and would inevitably trigger the wrath of powerful public sector unions demanding higher wages to cope with renewed inflation. This would hand the opposition a political sledgehammer just ahead of the 2026 election. The ruling party is making a high-risk gamble that it can maintain this fragile stability until after the polls close. But the final fateful decision will almost certainly rest with the next governor of the central bank. As the clock ticks down, three distinct paths lie ahead for Ghana, each with its own profound consequences. Path 1 is the path of least resistance, the keep the party going route. This involves continuing to spray US dollars into the market to defend the Cedi, all while praying that the price of gold stays red hot and global financial conditions remain favorable. This is the politically expedient option, the one that pleases voters today by keeping consumer prices low. However, it's a strategy that could evaporate the country's foreign reserves by tomorrow, leaving Ghana dangerously exposed and with no safety net when the inevitable shock arrives. Path 2 is the bitter medicine prescribed by the IMF. This would involve a complete policy reversal, immediately stopping all central bank interventions, allowing the Cedi to float freely, and likely hiking interest rates even further to combat the inflationary fallout from a weaker currency. This is the path towards long-term sustainability and credibility in the eyes of international investors. But it is also a politically excruciating fix, one that would almost certainly lead to a short, sharp shock of higher prices, public anger, and a significant political backlash just before an election. Path 3 represents a messy middle ground, an attempt to navigate between the cliff edge and the hard place. This would likely involve a gradual trimming of the dollar sales rather than a sudden stop, combined with the introduction of temporary import levies on certain consumer goods to offer some protection to local industries. The IMF isn't on a crusade to starve Ghana of funds or to punish its citizens. What it wants, above all, is credibility. The fund is demanding a clear, published rulebook that details precisely when, how, and for what reasons the central bank will intervene in the currency market. This transparency is crucial because it would signal to investors that the bank's actions are based on predictable economic principles, not short-term political whims. It's a call for policymakers to quit using the exchange rate as a blunt, all-purpose anti-inflation weapon. Professional investors already see the writing on the wall, treating the Cedi like a coiled spring, ready to snap back. Trading desks in London and Johannesburg are reportedly pricing in a 15% depreciation by March of next year, and the smart money is already hedging its exposure with currency forwards. Retail investors at home, however, lured by attractive headlines, keep snapping up 8% government treasury bills, with the looming forex risk being a distant afterthought. The clock is ticking, and the metrics are flashing warnings. Ghana's foreign reserves currently provide just over 3 months of import cover, which is already close to the minimum buffer recommended by economists. At the current burn rate, the pace at which the central bank is selling dollars, that crucial buffer could drop into the IMF's designated danger zone by December of this year. The external factors that fueled the rally are also showing signs of strain. Gold, the primary engine of the boom, is already off its May peak, and forecasts are pointing towards a potential cocoa crop shortfall, which would further squeeze dollar earnings. The most likely endgame, therefore, is not a sudden crash, but a carefully managed retreat. Expect to see a controlled 12% depreciation by next February, a move the government will undoubtedly rebrand with a positive spin like enhanced flexibility to soften the political blow. To appease angry farmers and manufacturers, this will almost certainly be accompanied by temporary levies on imported rice, poultry, and other sensitive goods. How will the IMF react? It will grumble publicly about the protectionist nature of the levies, but will ultimately release the next tranche of its loan program once Accra finally publishes that missing rulebook for currency interventions, handing both sides a partial victory. The economic consequences are predictable. Inflation, temporarily tamed, will likely re-accelerate toward 18% by the middle of 2026. This will force the central bank's hand, compelling it to implement a delayed but necessary rate hike, but only safely after the election is over. So, is the International Monetary Fund simply crying wolf, or is Ghana building a magnificent house of cards that is set to tumble in 2026? The Cedi's fairy tale performance feels brilliant and inspiring on the surface, but a quick scan of the footnotes reveals a rally that is not built on sustainable productivity, but bankrolled by finite reserves and a single volatile commodity windfall. The choice for Accra is clear and urgent. It can engineer a soft landing now through greater transparency, a wider currency trading band, and published rules of engagement. Or it can continue to defy economic gravity and let the market deliver a much harder, more painful landing later. The only real choice is whether Ghana's story over the next 2 years reads like a cautionary tale of a boon wasted or a triumph of timely reform. The final chapter of this high-stakes drama has yet to be written.